Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, March the 21st, 2025. Of course, this is option expiry day, so there's a lot of sort of buying and selling expiries this morning, and then, of course, the afternoon expiries. So who knows, maybe some volatility. Other than that, pretty quiet in the markets in the sense that there's a lot of not a lot of news. What is interesting is just the general, there's a bit of a sort of a risk on tone, especially over in Europe, but also US equities. And we see here, just as an example of that, we've got the futures on the Euro Stock 600. So it's a bit like the sort of S&P 500. You can see here that failure to make new highs and kind of gapping down a little bit at the 50-day moving average here, EMA. And there's some talk, even though the upper house in Germany just passed, the Bundesrat just passed the sort of the famous sort of defense and infrastructure spending plan, there seems to be a bit of a switch of attention. A lot of market commentators are thinking that maybe, a lot of the positivity in Germany and the broader EU has been priced in, and that the cold reality now is that the new government, which actually hasn't even formed yet, the new coalition. Remember, this has been done with the outgoing sort of parliamentary sort of composition. That's going to have to get down to the hard work of actually finding projects and sort of pushing this money out into the real economy and specifically also into the defense sector. And that is really a multi-year kind of situation. And so what I think has happened is that we had some initial euphoria and defense stocks have rallied and the broader European markets have rallied and the euro, the FX rallied. But now the reality is that this has set in. And the second reality check is that Trump continues to mention, sort of Liberation Day, as he likes to call it, April the 2nd, which is now about 2 weeks away, where he is threatening, and it does seem that there will be some significant tariffs put on almost every country. Of course, we know that there's going to be a lot of back and forward, sort of compromises, complications. But I think the sobering thought, or the thought which is sobering up the markets, is the idea that in places like Europe, there could be significant tariffs put on industries, exporting industries such as cars. So anyway, just to say that we are getting, especially over in Europe, if you look here at the Euro Stoxx 50, similar to the 600 sort of gapping down. You're also seeing in the Germany index, the DAX, not as badly affected, but still a little bit red. Again, these are not inflicting huge amounts of technical damage, but just a sense that, the euphoria is open. And it could just be that now that we've got the Fed out of the way, the German sort of spending package, it could just be that the market now is going to be waiting a little bit in suspension and in limbo until we get more clarity on sort of Liberation Day tariffs, so to speak. We're also seeing over in the US, if we look at the SPX here, finding it very, very difficult here. There was a kind of reactive bounce from this sort of 5,500 level in the SPX cash index. But as you can see here, 3 times it's been rejected on the daily charts here at the 200-day EMA. So that's a significant level. And what used to be a significant support, if you look at this 200-day going back a long, long time, it now seems to be turning into sort of overhead resistance. And you've got to say that at this point, what could be the catalyst for pushing up the US equity market into a real bounce? And I mean, it's interesting here because there's a similar kind of pattern if we observe the NASDAQ, which is way below the 200-day EMA. But again, just finding it very difficult to sustain any kind of bounce. And of course, if the smaller caps like the Russell had a bounce, but that's actually at the 20-day moving average, so very, very low. Similar kind of situation here if we look at the Mag 7s, trading in some kind of distribution, sort of consolidation along their recent lows, and a similar situation with the equal weight, which has done okay. But again, finding it hard to get above the 200-day EMA. So the bottom line here is that if we just pull back a little bit, what seems to be the sentiment is that the Trump administration does seem to want to go forward with negative growth policies, so trying to cut jobs, at least in the government sector, trying to cut unnecessary and wasteful spending. Both of those are sort of, in a certain sense, deflationary, but also anti-growth. And on the other hand, we have the tax cut bill, but there hasn't been a lot as extension. Not a lot has been said about that, and that could take quite a few months to come back in. And at the end of the day, that is a bill or a situation which is already sort of in law. So we're talking about an extension rather than new stimulus. From the Fed the other day, we did get a bit of a pullback in quantitative tightening from 25 to 5 billion. So that at the margin does add a little bit of liquidity, which is a positive. But the market is just finding it difficult at this point to look for this sort of good news. And we see that, for example, we had in FedEx overnight, we're getting let's have a look here. We had the FedEx sort of results out. Let me just find it here on the daily shot. Sorry, guys, let me just, I'm going to find it here. If we go down to equities, yeah, so you look at something like the daily shot here, you see that FedEx are down pretty low and then overnight down as well. And this is just the idea, as we see here, increasingly concerned about an economic slowdown here as FedEx. So there is this kind of vibe out there that, the US consumer is not doing well, and that company earnings are going to be hit, and that the tariffs are coming in, and there is quite a lot of negativity. So for sure, we are getting warnings. And if we look at something like, I just want to show you, which is quite interesting here, is just the way the different sort of income cohorts are spending their money. So if you look here, I'll just, let me make this a bit smaller. Basically, what we're getting here is, sorry, I just have to reduce this again. This idea that after the recession, so if you look here, we see this is the percent of spending. So this is basically the amount of money which people spend according to the sort of how much money they are spending. And what we're seeing here is that, again, just some interesting stuff here, that this is compared to the typical pre-pandemic savings rate. And what we're seeing, this is on the bottom left here, when the pandemic was declared, we can see that people in the top 10% started saving a greater percentage of their income. But that also applied to the other 90% of earners. So the beginning of the pandemic, when a lot of people were staying at home, not spending as much money on transport and maybe restaurants and services, but still receiving an income and getting a lot of fiscal support from the various governments, they actually were able to put aside a lot of money. And so that created quite a big chunk of sort of sustained household wealth, not only for the top 10%, but more broadly in society. But what we're seeing here, that inflation, you see peak inflation here, it's kind of halfway through 2022. What we're seeing is that since then, the top 10% have maintained their cumulative excess savings. So they're not spending that big a percentage of their income, and they're still able to spend. Whereas the other 90% is progressively able to save less and less money, which is gradually slowing down the economy. And this is one argument to say that maybe the economy could be slowing down. Another way of looking at it, again, is just to look at the percentage of the share of spending by income group. So it's kind of interesting now that if we actually look at who spends money, because the point I'm trying to get to here is that on one hand, you could say that lower income earners, they spend most of their money, but they have less money to spend because of inflation. And therefore, that's going to be a negative for the economy. But then we have to say, well, who actually keeps the economy rolling? Who actually spends the dollars? And what we can see here is that the top 10% of earners, so the wealthiest 10% are actually accounting for half of all spending. And if we look, let's say, for example, the lowest 20% of earners, we can see that they only spend a little bit. So what you can see is that the bottom, 10, 20, 30% of earners don't really spend much. And really, a lot of this discretionary spending in the economy is the wealthier parts of the population. So that's kind of interesting to think that we have this K-shaped economy now, where you have the top 10 or 20% who are earning a lot of money, who are not worried about inflation, and they're the ones who are still spending quite a lot. So that would argue against this idea of the economy going into some kind of recession, because we do see a lot of sort of charts which say things like, credit card delinquencies are up, and subprime car loan delinquencies are up. And that is true. That's absolutely true. But remember that is kind of a marginal sort of spending. So that would argue for a slightly sort of more sort of optimistic sort of take on things. And another way of looking at that is that, let's say, for example, we go to just want to go back to some data. We had, for example, initial jobless claims. So I just want to show you the initial jobless claims and put this in a bit of context here. So we had the number yesterday, which was pretty low. And here we go. So we see here yesterday, numbers. And now, so this 2025 is in the deep blue here. So you see this blue here. And what we can see is that this is where we are now in this deep blue. And you can see yesterday we got about, I think, 220,000 initial jobless claims. That's people filing for unemployment benefits for the first time. And we can see here that this is historically in low, and it's historically in a low range. And in terms of this year, this is actually, we're at about week 10 or 11. That's actually sort of going down and is pretty solid. So looking at the labor market, there's been a lot of talk that Doge is cutting jobs and the US economy is about to go into recession. But the point is, at this moment, and this is a weekly chart, which is relatively timely, at least from an employment situation, this doesn't seem to be a disaster. Now, I know other employment indicators and some other economic indicators are lagging, and they tend to lag really what happens. And the Fed sometimes is a little bit too backward looking. But just to say that a key measure for the Fed is the employment, and Powell is right to say that at this point it's looking relatively solid. So the thing here is that if we go back and then look at the stock market, and we see an enormous amount of pessimism. A lot of that is sort of predicated on this idea that the tariffs are coming, which it does seem is true in some shape or form, and that the tariffs will cause a little bit of a stagflationary bump. So a little bit of a maybe just a one-off, but certainly some price rises, and certainly maybe a slowdown in global trade and global growth, and specifically US growth and maybe European growth. And I guess that's going to contaminate into China, et cetera, et cetera. And so suddenly we're going to get this sort of global growth is it going to be not only a scare? So the real question we have to try and figure out, and this is what the market is trying to do, is that was this sell-off here in the stocks a US and global growth scare? Now, then the question is, are we actually going to have a reality where Trump's policies in terms of tariffs will actually call a real growth slowdown, not just a scare? And so could we have a situation whereby, I don't know, maybe the stocks have some kind of bounce here, they try and get up a little bit, and then we actually have a genuine kind of like a serious sort of a correction going into the next quarter or two. That's going to be quite interesting. But certainly at this point, certainly at this point, it seems as though I just want to kind of trying to get rid of this. Yeah, so it certainly seems at this point that the technical barriers are both, especially in the US, the market is finding it hard to rally. So it almost seems like it's sort of a sell call situation. Maybe not a long put situation at this point, but maybe a sell call if we get to sort of certain sort of technical barriers. Anyway, interesting stuff to be looking out for. If we look at other markets, like for example, just looking at a couple of currencies and just generally what's happening. If you look at oil, for example, you can see that OPEC yesterday, they came out with some numbers saying that, certain, don't want to go into the details, but compensatory sort of cuts for countries which had been overproducing were actually now going to cut a little bit. There's some talk about 400,000 barrels a day. The market got a little bit of a pop on that. The market also got a little bit of a pop, a couple of sanctions from the US on Iran. By the way, we have Defense Secretary Hegath speaking with Trump this afternoon. Possibly there could be some comments on Iran. So definitely the rhetoric is ramping up between the US and Iran. So could there be some announcements of extra sanctions? That, in theory, would be a little bit of a short-term positive on oil. But my point being that even with this talk about some sanctions, potential sanctions on Iran, and even with the talk of, further sort of micro cuts from some of the OPEC plus countries, oil is finding it hard to have a sustained rally. And my base case is that the really the bigger picture here is that the global growth sentiment is a little bit negative or a little bit pessimistic. And again, technically, this to me does feel, I could be wrong, could just be a sideways grinding upwards consolidation, but it does feel to me a little bit like a bear flag. So I'm just kind of curious to see if it can break out of the top of that mini sort of upwards resistance line here. We see so far today oil down a little bit, just not a lot, but just down a little bit. And I'm just curious to see whether oil can actually break out. At this point, as you can see, all the moving averages are sloping downwards, so not looking good. If you look at the time spreads, not particularly solid. I mean, the curve is okay, but not particularly solid. So that's that one there. If you also look at I mean, just looking at some of the currencies, if you're looking at the sort of risk on, risk off kind of sentiment, if we go, let's say, to the Aussie dollar, again, trading heavy or heavily, just not able to, go above. You see here some of these moving averages, the 20 and the 50, kind of going flat sideways in a bit of a sideways grind. even with some attempts at stimulus in China, these currencies such as the Canadian, the Aussie, New Zealand, these commodity currencies, they're finding it difficult to have a sustained rally. Even in the case sometimes of a bit of US dollar weakness, just because there's this sense that, China is flooding the global markets. I was reading something yesterday about Indonesia with cheap products. There's the threat of tariffs, reciprocal tariffs. This is not good for exporting nations like Australia and the currency. So Aussie down a bit weak. If you look at New Zealand here on the futures, you see, a little bit stronger, but still, just finding it hard to really sort of get a lot higher. And if we look at something like USD CAD, that's just stuck in a range here, essentially waiting for sort of Liberation Day on April the 2nd here. And interesting again, if you look at Canada, just to get a sense of like confidence, what this kind of tariff threats are doing. Again, if we go back to let's have a look at the daily shot here and look at look, I think I've got some data here on Canada, just some confidence numbers. Yeah, so if you look here, sort of small business sentiment collapsed. So you see here a record low in the Canadian, the Business Barometer Index. So even lower than COVID, Great Financial Crisis or September 11. So very, very pessimistic in Canada. And you see here everything, across all of the industries, construction, transport, manufacturing, a lot of negativity in Canada. You can go through all these numbers here. And basically that's just showing us that even you hear people talking about this. So just anecdotally. So I think in Canada, definitely the potential for a slowdown. We had Macklem yesterday from the Bank of Canada essentially saying that, if the tariffs were to be imposed in any kind of long lasting and serious manner, that would most probably lead to at least a small scale recession in Canada. So therefore, it's difficult to see USD CAD collapsing here unless, Trump on April the 2nd signals, maybe no tariffs or very, very limited tariffs. But mainly sort of indecision. We're also seeing this over in Europe. We see that the euro had a very, very nice bounce. Again, a lot of this whole sort of narrative of the rest of the world doing much better and a lot of money flows going from the US into the rest of the world, specifically Europe. For sure, that's a possibility. But just at the moment, that's been checked, and you see at this resistance here, 109.5, just coming down a little bit. We had Lagarde yesterday also just saying that she couldn't to any more cuts in the Eurozone, a bit worried about tariff uncertainty, et cetera, et cetera. Now, of course, if tariffs were to be imposed by Trump on Europe and things like the car exporting industries, one could assume that the ECB probably would become a little bit more dovish and would want to actually start cutting a little bit more. But overall, that would not be good for the euro. And of course, any kind of hint of a recession or an economic slowdown would also be euro negative. So it's going to be interesting to see here if the euro can actually pop, higher than this sort of level here. I think that's going to be quite substantial resistance. Just keeping on with the currencies, overnight in Japan, we did get a higher than expected CPI so the inflation number. Market didn't have a big reaction, as you can see here on the daily. This is USD JPY. Not a huge amount of energy. In fact, if anything, the yen, actually lost a little bit there, but still, it looks as though the Bank of Japan is the only major sort of central bank which is in a hiking cycle. Will they go in May or will they wait to the meeting after? We don't know. But essentially, I think any kind of rallies here in USD Japan, or even anything else which rallies against Japan, you want to be long Japanese yen at an attractive point, because the reality is that inflation is edging upwards, which is encouraging for the Bank of Japan. They do want to hike interest rates, and they do want to sort of reflate the economy a little bit. Apart from that, guys, not a huge amount happening. As I say, we have the option expiry today. Just finally to finish off, if you look at the yields, you can see the yields are going down. Again, just on this risk-off sentiment, we see the bonds have bounced from a level. We see here, for example, the US 10-year yields are just going down a little bit. And just, I think, on this idea, just looking through it, Powell had to say that he doesn't seem particularly worried about inflation. He believes that even if with tariffs, that could be like a one-off kind of price level change rather than a sort of a structural inflation thing. He didn't seem, as I was saying yesterday, to be particularly worried about long-term inflation expectations. But what he did signal is that, they're clearly very focused on the real economy, specifically the employment numbers. And if the employment numbers were to weaken, which, as I say, they're not, but if they were to weaken, and if the general economy were to weaken quickly and significantly, significantly, I think the market is taking away from that Powell and company would be pretty quick to pull the trigger in terms of doing more cuts. And just to finally to look at that, we're actually pricing in at the moment about almost three cuts. If you look here, at least on the Fed funds futures. So if you go out to the December meeting of 2025, 2.8 cuts, almost three cuts. So again, pretty dovish. The market hasn't really sort of walked that back. And if you look just to get a bit of a sense of where actually market participants are for that, which I always like to have a look, you can see here just going out to the December meeting on the CME FedWatch tool that this is where we are now, 425 to 450. So we're here. So it looks as though 20% of sort of positions, at least based on the Fed funds, is calling for two cuts. But quite a few people also calling for 33% calling for three cuts. So it seemed like mathematically we'll see here somewhere between 2.8 to three cuts. But there are still some holdouts who are essentially saying maybe just one cut. And again, some people calling for even what's that, 1, 2, 3, 4 cuts, and even to 5 cuts. So does that become out of the money kind of sort of hedging possibly? But there is a certain portion of the market who actually is expecting some sort of real economy weakness, and therefore a much more dovish Fed going in to the next quarter or two. Okay, I'll leave it there for today, guys. Have a great day, a great weekend, and we'll keep on doing this next week. Thank you.